I want to show you a number. $14,517. That is how much a 32-year-old named Marcus paid in credit card interest over 11 years. Not his balance, not what he spent, just the interest. Just the fee for borrowing money he already borrowed. $14,000. Gone. And here's what makes it worse. After 11 years of payments, after $14,000 of interest, Marcus still owed more than he did when he started. If you have a credit card balance right now, and you're making minimum payments, you are Marcus, and the bank is counting on you to stay that way. I'm Felix, and what I'm about to show you is the math they never teach you. The math that explains why Americans are carrying $1.28 trillion in credit card debt right now, and why that number keeps going up every single quarter, without fail. Here's what you're getting today. First, the minimum payment trap. Exactly how it works. The math is simple. The result is devastating. Second, why banks designed it this way. This is not an accident. This is a business model. Third, how to calculate exactly how long you're stuck and how much it's costing you. Your specific numbers, right now. And fourth, the fastest mathematically correct way out. Not motivation, not cut your lattes, the actual math of debt payoff. By the end of this, you will never look at a minimum payment the same way again. Let's start with where we are. As of this year, Americans carry $1.28 trillion in credit card debt. Trillion. That number crossed $1 trillion in the summer of 2023. 2.5 years later, it's added another $280 billion on top. The average household carrying credit card debt owes $7,886. The average interest rate on that debt, 22.3%. Let me put that in human terms. A family carrying $8,000 on a credit card is paying $1,759 a year in interest alone. That's $146 every single month, just in interest, not paying down debt, just staying still. For context, the average 30-year mortgage rate is around 6.8%. Credit cards charge you 3 times that. 3 times. For debt that is often just groceries, gas, a car repair. The things that happen when you don't have a cushion. And 53% of Americans are living paycheck to paycheck. 53%. That means more than half the country is one unexpected expense away from making this worse. Now, let's talk about the trap itself. You get a credit card statement, there's a balance, and there's a little box at the bottom of the statement. Minimum payment due. It's usually 2% of the balance, sometimes a flat $25, whichever is higher. It feels helpful. At least I can afford this. I'll pay more next month when things are less tight. Here is what actually happens. Let's say you carry $5,000 on a card at 22% interest. Your minimum payment on $5,000 is about $100 a month. So you pay $100 a month. Of that $100, $91.67 goes to interest. $8.33 goes to your actual balance. $8 every month. You're paying $100, and $8 of it is actually paying off your debt. At that rate, paying only the minimum, it will take you over 21 years to pay off $5,000. You'll pay more than $9,000 in interest on a $5,000 balance, almost double what you borrowed. Gone. And this is not a worst-case scenario. This is a completely average American credit card situation. Here's where it gets uncomfortable. This is not a mistake. This is not an oversight. Banks didn't set up minimum payments to help you. They set up minimum payments to maximize the amount of interest you pay over time. A minimum payment is carefully calculated to keep you in debt for as long as possible, while feeling like you're doing something. Think about it from the bank's perspective. You borrowed $5,000. The bank charges 22%. If you paid it off in 6 months, they make maybe $250. If you make minimum payments, they make $9,000. That's not a financial product. That's a subscription you never signed up for. The Credit Card Act of 2010 actually required banks to print on every statement how long it would take to pay off your balance with minimum payments only. They had to put it in writing, and people saw it, and still kept making minimum payments. That's how deeply the habit is wired. That's how normalized it's become. I'll pay the minimum this month. Things are tight. That sentence, every time you say it, costs you years and thousands of dollars. I want you to do something right now. Go to your credit card app or your statement. Find your current balance. Find your interest rate, your APR. I'll wait. Now here's how to calculate what minimum payments are actually costing you. Take your balance, multiply by your APR, divide by 12. That's how much of your next payment goes to interest. If you owe $4,000 at 22%, 4,000 times 0.22 is $880 per year in interest. Divide by 12. That's $73.33 going to interest every single month. If your minimum payment is $80, you're paying down $6.67 of actual debt per month. $6.60 per day to pay off $4,000 in debt. At that rate, you will be making this payment for longer than most romantic relationships last. But here's what I don't want you to do with this information. I don't want you to feel ashamed. Almost nobody in this situation got here by being irresponsible. They got here by being underprepared, by not knowing the math, by doing what the bank's statement made look reasonable. The problem isn't you. The math is designed to look manageable when it isn't. Now you know what you're looking at. Let's talk about how to get out. There are two mathematically proven methods for paying off credit card debt. Both work. They work on different humans. Method 1. The Avalanche. List all your credit card debts from highest interest rate to lowest interest rate. Pay the minimum on everything. Then take any extra money you have, any amount, and throw it at the highest rate card first. When that card is paid off, take everything you were paying on it and add it to payments on the next highest card. This is mathematically optimal. You pay the least total interest. You get out the fastest on paper. It requires patience. Your first win might take a year. Some people find it hard to stay motivated when they don't see early victories. If that's you, Method 2 is for you. Method 2. The Snowball. List your debts from smallest balance to largest, regardless of interest rate. Pay minimums on everything. Throw extra money at the smallest balance first. When you pay off the smallest debt, you feel something. You feel progress. You feel capable. And you roll everything you were paying into the next smallest debt. Dave Ramsey made this famous, and behavioral economics supports it. People who use the snowball method are more likely to complete their debt payoff journey, even though they pay slightly more interest, because the psychological wins keep them going. Pick one, not both. Not a hybrid. Pick the one that matches how your brain works. The best debt payoff method is the one you'll actually stick to. Now, two things that turbocharge either method. First, balance transfers. Many credit cards offer 0% APR on balance transfers for 12 to 21 months. If you have good credit, above 670, you may qualify. Here's what this means. You move your high-interest balance to a 0% card. For the next 12 to 21 months, every dollar you pay goes directly to the principal. 0 goes to interest. The math is dramatic. $5,000, 21 months, 0 interest. Your payment is $238 a month to clear it completely. Same payment on a 22% card? You'd still have nearly $4,000 left. There's a transfer fee, usually 3 to 5%. Worth it. Almost always worth it. Do the math first, but usually worth it. Second, find $100. Not $1,000. Not a windfall. $100 a month of extra payment on a $5,000 balance at 22% cuts your payoff time from over 21 years to under 4 years and saves you nearly $7,000 in interest. $100 a month. That's what restructures your entire financial situation. Not a lottery win. Not a promotion. $100, found in subscriptions you forgot about. In one restaurant meal per week. In renegotiating one insurance rate. $100. One final principle. If you don't change the behavior that created the debt, paying off the debt just makes room for more debt. This is the most common trap. Person pays off their card, feels relief, keeps the card, keeps the habits. 2 years later, the balance is back. The cycle repeats. Debt payoff and financial behavior change have to happen at the same time. This doesn't mean you can never use a credit card again. Credit cards have legitimate uses: rewards, fraud protection, credit building. It means you need to understand the difference between using a card and paying it off monthly, and using a card as a loan. One builds credit. One costs you 22% a year. Every month you carry a balance. You are paying a 22% fee for the privilege of spending money you didn't have. Every month you pay in full. You use the bank's money for free and get rewards for it. The card is the same. The behavior determines which side of the transaction you're on. If you made it here, you now know something that took Marcus 11 years and $14,000 to figure out. The minimum payment is not a lifeline. It's a slow drain. The good news is, the math works in both directions. The same compound interest that makes debt so expensive to carry makes extra payments disproportionately powerful. Every extra dollar you pay saves you 3 or 4 in interest down the line. The math is on your side, but only if you use it. Most people will watch this, feel a moment of panic, and then go back to making that minimum payment. But you're still here. You're looking for the exit. If you want to master the math that the banks hide from you and build wealth that actually stays in your pocket, hit the subscribe button. It tells the algorithm that this knowledge matters, and it ensures you don't miss our next deep dive into the system. If something in this video landed, if you grabbed your statement and did the calculation, there's a button below this video. It means more of these. Take care of your money. This is educational content only and does not constitute financial advice. Always consult a qualified financial professional for your specific situation.